Welcome to the deep dive. We're here to, cut through all that noise and hopefully deliver some clarity because, let's face it, in today's world of finance, geopolitics, tech confetti, it's moving so fast it feels overwhelming trying to stay properly informed.
Absolutely. Information overload is real.
Right. So that's our mission today. We're taking this really compelling stack of insights you've shared with us, sources covering everything from digital assets, shifting global power, to some, well, frankly, surprising market plays, and we're going to distill it.
Try to make sense of it all.
Exactly. Help you connect the dots on what's actually happening out there. Okay, let's unpack this fascinating collection. Get ready, because I think this is where it gets truly thought-provoking.
Yeah, and what's particularly striking about this material, I think, is how these things that seem quite separate, digital assets, this big geopolitical chess game, looking again at industries we thought we understood, they're actually all deeply interconnected.
So,
Well, they reflect these profound, really fundamental shifts in how value is created and, frankly, how power is wielded across the globe.
okay, that makes sense. And when we talk about shifts in value, digital assets seem like the obvious place to start. The pace of change there is just breathtaking.
It really is.
Many might still see it as a bit niche, maybe, but your sources, they reveal a scale that's genuinely surprising. The total digital asset market cap, it's now at an astonishing $4.1 trillion.
Yeah, $4.1 trillion. It's huge.
To put that in perspective, that's incredibly close to NVIDIA's market cap, which is around $4.47 trillion. And it's already, 8% of the entire S&P 500?
8%. It's not insignificant anymore.
Not at all. Just think for a moment how quickly the sector has grown, to stand alongside these established giants. But despite that huge growth, investor exposure, still remarkably low.
That's the paradox, isn't it?
Only 9% of investors have any crypto exposure. And the average portfolio allocation is tiny 0.3%. Compare that to gold, 48% of investors have some, with a 2.2% average allocation.
Which definitely raises a big question. Why? Why do so few people have meaningful exposure to something expanding so rapidly? Especially when you look at the performance.
Exactly. What's the thinking there?
Well, our sources suggest a pretty compelling rationale for Bitcoin's success, actually. One source notes, Bitcoin might be winning simply because it has the least amount of human intervention.
Less human intervention.
Interesting. And that lack of human meddling is incredibly crucial right now, I think. It speaks to this fundamental desire for trust, for decentralization, especially when trust in traditional institutions, traditional systems, seems increasingly strained.
That resonates.
And the numbers, well, they really underscore this point. $1,000 invested in Bitcoin back in 2010. That'd be worth over $2 billion today.
$2 billion. It's hard to even comprehend.
It is. It just hit a new record high, around $123,000. And yet it's still only about 1/10 the market cap of gold. There's still room, potentially.
Right. And it's not just individuals jumping in anymore, is it?
No, absolutely not. Corporates now own 1.86 million of the total 21 million Bitcoins. That points to a deeper societal shift, perhaps.
How so?
Well, think of the analogy presented in the sources. Bitcoin as the vault no fire can burn versus Google as the Library of Alexandria.
Okay, I like that.
In a world flooded with AI, where data is cheap, often synthetic, maybe even unreliable, there seems to be a clear move towards valuing true scarcity, immutable trust, over just having tons of information.
That vault versus library analogy really crystallizes it, yeah. But Bitcoin isn't the only player here, is it? Ethereum keeps coming up.
Oh, absolutely. Ethereum is crucial. Your sources highlight its role as the institutional protocol, basically the foundation of the next financial system.
Foundation, strong words. Where do we see that in practice?
You see its utility everywhere.
Yeah.
Major platforms like Coinbase, Robinhood, they're building their layer 2 solutions on top of Ethereum.
Right, the layer 2s for speed and cost. Can you briefly explain what those are for listeners?
Sure. Layer 2 solutions are essentially frameworks built on top of a main blockchain, like Ethereum. They're designed to make transactions faster and cheaper by processing them off the main chain initially, then settling them back onto it later. It really helps Ethereum scale.
Got it. So it cements Ethereum's role as core infrastructure.
Exactly. And the huge stablecoin boom. That's largely happening on Ethereum too. Plus, unlike Bitcoin treasuries, which are mostly just sitting there as a store of value, ETH treasuries offer actual utility. You can stake them, earn yield.
So there's more you can do with it.
Precisely. Now, okay, Ethereum might have higher costs sometimes. Maybe it's a bit slower than some newer chains, but its decentralization and security, they're seen as paramount. It's really, as one source put it, the glue holding together the most interesting experiment the tech world's managed to put together in a decade, or maybe ever.
That's quite a statement. The glue.
It is. And look, it's not always a smooth ride in this new frontier. Our sources mentioned what they call a wobble recently, creating a potential opportunity in companies holding significant Bitcoin or Ethereum in their treasuries.
These treasury companies, right, like STRC?
Exactly. STRC offers, what, 90% Bitcoin exposure? These are companies that basically act as a proxy for crypto investment. They hold a lot of the digital asset on their balance sheet.
So investors get that exposure, but maybe with more volatility.
Definitely more volatile, yes. But that volatility comes with this unique potential upside of accumulating Bitcoin quickly if the price moves favorably.
Okay. And then there's bullish, BLLSH. That's an interesting one.
A fascinating case study. It aims to be the BlackRock of crypto. It saw this massive market cap jump when it listed on the NYSE, even though it had recent losses. It highlights this paradox your sources vividly describe as communists in pinstripes.
Communists in pinstripes. That's evocative. What exactly does that mean in this context?
It's a powerful phrase, isn't it? It captures this tension. You have the anti-establishment, decentralized roots of early crypto clashing with, well, the very traditional capital structures of Wall Street.
So revolutionary tech seeking establishment money.
Pretty much. Ventures born from disruptive tech, but now seeking the legitimacy, the capital, of the system they initially wanted to bypass.
Yeah.
It creates these really interesting, sometimes quite contradictory situations as crypto pushes into the mainstream.
Okay. So pulling this together,
Yeah.
what does this huge shift in digital assets mean for something really traditional, like financial planning?
Well, your sources offer a pretty stark critique here.
Yeah.
They argue the financial planning industry often just ignores digital assets, completely overlooks them, despite their, top performance over 1, 3, 5, and 10 years.
The numbers are hard to ignore, aren't they? Bitcoin's return over the last decade, what was it? Over 42,000%, compared to the S&P 500's 263%.
Exactly. Plus 42,603% versus plus 263%. It's a massive difference. So if we step back, look at the bigger picture implications. It suggests the market is basically signaling that you're almost being forced to be long assets, whether they're physical or digital.
Forced long assets. Why?
Because in this environment of ongoing currency debasement, inflation. Cash is, frankly, dying in value. Central banks globally have expanded money supplies so dramatically, it just erodes purchasing power over time.
So holding cash is losing ground.
It's a compelling argument that to keep or grow your wealth, you need to be invested somewhere, somehow, just to retain value.
Wow. Okay, these shifts in wealth are clearly profound, but they don't happen in a vacuum, right?
Yeah.
Your sources show they're deeply tangled up with these huge changes on the global stage.
Absolutely intertwined.
So let's shift gears a bit. Let's look at the high-stakes world of geopolitics, power dynamics. Your sources paint a fascinating, maybe slightly unsettling picture, particularly around this anticipated Trump-Putin meeting, August 15th in Alaska, is that right?
That's the date mentioned, yes. And the description in the material is quite vivid. It calls the summit the diplomatic equivalent of watching your eccentric relative hand over the car keys to a stranger they've just met.
Yeah, okay, that paints a picture. And there are European concerns.
Clear concerns, yes. Especially given Trump's, say, unconventional preparation, like sending this property developer described as a sort of unconventional wheeler dealer to Moscow beforehand.
Not exactly traditional diplomacy.
Not really. And this raises a big question. Is this some genuine diplomatic breakthrough attempt, or is it more of a calculated power play? What's really going on?
Do the sources offer any clues?
Well, they detail alleged demands from Putin, supposedly leaked by the Italian newspaper Corriere della Sera. It's quite a list.
Like what?
Things like Ukraine pulling out of the Donbass region, Russia maybe shuffling out of some other areas, freezing the front lines. And critically, Ukraine never joins NATO, becomes demilitarized, adopts a federal system.
That's a lot.
It is. And crucially, the sources highlight this desire, allegedly, for a bilateral Trump-Putin deal, cutting out Ukraine, cutting out the EU entirely. Or maybe Trump just stops the weapons shipments. It's presented as a very bold set of potential terms.
Wow. Okay. And this ties into this provocative idea mentioned in the sources, this new empire thesis.
Exactly. The argument presented is that, quote, the U.S. hasn't lost the plot, it's just changed genre, shifting from being a perhaps weary republic into more of a swaggering imperium.
A swaggering imperium. Okay. And how does Russia fit into that?
This is where it gets really interesting, according to the material. The idea is that Trump's potential masterstroke is this Russia pivot, turning Russia from an enemy into, well, maybe not an ally, but something different.
Why would they do that?
It's seen as driven by the drawn-out Ukraine conflict, the cost, and the strategic advantage of potentially breaking up that China, Russia, Iran, North Korea bloc.
Disrupt that axis.
Precisely. And from Russia's perspective, as presented in the sources, reaching out to Washington is framed almost as survival, a way to avoid becoming just a junior partner to China.
Interesting dynamic.
And the supposed beauty of this new empire, according to these sources, lies in its simple terms. You don't have to like people. You don't have to talk about rules-based BS, as they put it. You just make them kneel, cut the deal, keep the peace. It's very transactional.
Very transactional. And what does this mean for Europe in this scenario?
Well, this approach, as laid out in the material, has pretty profound implications for Europe. The sources suggest Europe is facing the consequences of, quote, 30 years of building an empire on 4 scams.
4 scams. What are they?
Defined in the material as cheap Russian gas, relying heavily on the U.S. military for defense, using Chinese sweatshops for cheap goods, and running on borrowed credit.
Oof, that's a harsh assessment.
It is. And the direct market implication drawn from these potential geopolitical shifts is also significant. A compelling argument to buy defense stocks.
Why defense?
Because the thinking presented is that nations will have no choice now but to rearm or roll over. If the U.S. potentially pulls back its security umbrella or changes its priorities, nations feel they need to fend for themselves.
Makes sense.
The material also includes this provocative claim. The West went all out to destroy Russia, and it didn't collapse because their strategy was wrong and their narrative was wrong. And the follow-on is, Russia now has a huge war-conditioned army, and the West is in trouble with no ammo, no men, and less money.
That's a very stark counter-narrative.
It is. And it's also noted that U.S. interests seem to be shifting towards Eurasia, maybe viewing Europe as not so important anymore. So the wider context presented suggests 2 stark options emerge. Either destroy Russia or find a way to work with Russia. It's framing a fundamental reevaluation of the entire global order.
That's certainly one interpretation, and yeah, a pretty stark one. Okay, so if these massive macro shifts are reshaping finance and global power, where do your sources suggest the maybe unexpected opportunities lie in the market itself?
Right, let's dig into some of the more contrarian plays and insights found in the material.
Okay, there were some really audacious moves mentioned in the AI space, like Perplexity AI making that bid for Google Chrome. $34.5 billion.
Yeah, described as impudent, wasn't it? Portrayed as audacious theater.
Theater.
Meaning maybe less about actually buying Chrome and more about grabbing headlines, signaling Perplexity's serious intent in that AI browser space. Especially with Google facing all that monopoly scrutiny. It's a bold move for a company supposedly not even worth half the bid amount on paper.
A publicity stunt with strategic intent, perhaps.
Could be. And speaking of valuations, this immediately brings up the point about NVIDIA. Your sources note NVIDIA, arguably the world's most valuable company now at $4.47 trillion, trades at 34.5 times sales.
Times sales, not earnings. That's high.
Extremely high. Described in the source as less a valuation and more like a drunken promise at a wedding, it's a multiple that really defies traditional metrics.
A sign of the times, maybe?
Perhaps. And it's not just the multiple. There's this curious detail mentioned about the U.S.-China chip deal. NVIDIA reportedly gives 15% of its revenues from selling slower chips to China directly to the U.S. Treasury.
15% off the top to the government.
That's what's reported in the source. It's a remarkable arrangement, isn't it? Suggests some really deep geopolitical entanglement, even in the tech sector.
Definitely. Okay, beyond the AI giants, your sources point to some other, maybe hidden gems, underappreciated sectors.
Yeah, absolutely. Take Lightbridge, ticker LTBRUS, highlighted as a top idea.
What do they do?
They focus on manufacturing advanced nuclear fuels, but here's the kicker. They use repurposed plutonium from old weapons stockpiles.
Wow, swords into plowshares, literally.
Exactly. It's positioned as not just niche, but potentially a huge thing for clean energy and non-proliferation, turning a global threat into peaceful power.
That's fascinating. Then there's cannabis. Specifically, GLSF US presented as a perfect contrarian setup.
Right. The sources describe it like this. The initial hype's gone, the sort of stoners and Patagonia fleeces have been cleaned out, financially speaking. But underneath, the industry is quietly changing, maturing.
So the froth is gone, but the substance is emerging.
That's the idea.
Yeah.
Glasshouse, this specific company mentioned, is described as sitting there with half-empty greenhouses and balance sheets that don't scream money laundering front, which is colorful.
Yeah.
But they point to strong financials, backing this up.
Yeah.
Revenue's up, costs are down, cash flow has doubled. And there's this potential for what the source calls an absolute face melter upside if, and it's an if, federal rescheduling of cannabis happens in the U.S.
Okay, face melter upside. Why is that rescheduling such a massive potential catalyst, and why might the market be missing it?
Well, the face melter idea comes from the fact that rescheduling cannabis federally would just fundamentally transform the entire industry overnight. It would unlock huge amounts of institutional investment currently sitting on the sidelines. It would allow for interstate commerce, which is a massive logistical hurdle right now. It could dramatically lower operating costs by easing banking restrictions and fixing punitive tax codes like 280E, and just generally open up much broader market access.
So a total game changer.
Absolutely. And the market might be missing it because, well, it's been burned before by hype cycles in cannabis. Plus, many big institutional investors are still legally or constitutionally unable to touch the sector until rescheduling happens. So it's a classic case, potentially, of an industry quietly getting its house in order while everyone's looking elsewhere.
Fascinating. Okay, moving to another one that caught my eye. Nebius, NBIS, an AI infrastructure company, introduced with this really powerful line in your sources.
Which one was that?
You want peace in Ukraine. Nebius isn't just in that war. They're building the very infrastructure of the battlefield itself.
Yes. Quite a statement.
It sounds like more than just hyperbole, though. It's positioned as an AI infrastructure play that's seen explosive growth up 148% year to date, targeting massive data center capacity, 1 gigawatt by the end of 2026.
That's the projection mentioned. And that kind of capacity could generate billions in revenue. Your sources really emphasize that Nebius is, quote, not just selling GPUs, it is building one of the most vertically integrated, high-margin AI infrastructure platforms in the world.
Vertically integrated, why is that distinction important?
It's crucial. Nebius isn't just acting as a reseller, buying hardware and renting it out. They're apparently integrating every layer of the AI stack, designing the data centers, managing power solutions, handling the compute, the software.
The whole package.
Exactly. That level of vertical integration allows for potentially huge efficiencies and much higher margins compared to just reselling. It positions them as potentially a foundational player in this massive, escalating demand for AI compute power.
Got it. Okay, next up, Cardiol, CRDL US. This one seemed a bit complex. A narrative around its Archer trial for inflammatory heart disease.
Yes, quite nuanced. There was a stock price drop, lots of noise on social media apparently shouting, trial failed.
Right. But the sources emphasize a specific finding, left ventricular mass reduction, with a p-value just over the usual threshold, 0.0538.
Correct. Now, for listeners maybe not familiar with stats, P0.05 is the conventional cutoff for statistical significance. So 0.0538 is technically just outside that.
So, not significant then.
But here's the nuance. Your sources stress that medical experts often interpret this differently, especially in phase 2 trials. They see it as a very strong positive signal. Why? Because left ventricular mass reduction itself is considered a, quote, stone-cold proven predictor of death, stroke, and heart failure.
So the biological effect is really important, even if the statistic is borderline.
Precisely. There's a disconnect between snapshot social media reactions and deep expert interpretation. Medical conferences, the material argues, not Twitter, are the real arbiters here. Experts understand that in phase 2, the goal is often to show a strong trend, a biologically meaningful effect.
So it's about direction and magnitude, not just a strict p-value cutoff.
Exactly. The clinical significance of actually reducing LV mass is seen as so profound that this finding, even at p0.0538, is viewed by experts referenced in the sources as a resounding yes for future development, a strong indicator the drug is likely working, setting the stage for a larger phase 3 trial.
That makes sense. A really important distinction between statistical significance and clinical relevance.
Absolutely. And staying on healthcare, United Healthcare, UNH-US, is also noted. Potential for huge margin recovery seen in 2026.
Why 2026?
Due to anticipated rate increases in the ACA, the Affordable Care Act marketplaces may be 20–30%. The suggestion is the market might be underestimating that future earnings growth potential.
Okay. So when we pull all these different threads together, what does it say about the future of work, of investment, especially contrasting it with this dominant AI hype train we keep hearing about?
Well, your sources offer a really compelling, quite contrarian view on that. They highlight all of the unappreciated and underpaid jobs that AI, at least for now, simply can't touch. Essential roles. Tarmac layers, nurses' aides, construction workers, things that require physical presence, dexterity, maybe empathy.
The hands-on stuff.
Right. And core argument presented is that the smart bet is on the unsexy stuff. Things like healthcare staffing agencies, industrial equipment hire firms, construction contractors. Because, simply put, if robots can't do it yet, humans still have to.
It really forces you to rethink where the true value, the real necessity, lies in the economy, doesn't it? Beyond the shiny new tech.
It really does. And if we zoom out again to the even broader implications, it's clear that energy, right across the board from traditional oil and gas right through to nuclear, seems to be experiencing a significant long-term secular tailwind.
Why energy specifically?
Well, just the demand from data centers alone is putting immense pressure on the energy grid. It's highlighting decades of underinvestment in energy infrastructure globally.
All that AI compute needs massive power.
Exactly. Your sources specifically point to potentially increasing exposure in areas like drilling contractors, underwater infrastructure plays for oil and gas, and also these long-term customer commitments being signed by next-gen nuclear players like Oklo and Stellaria, mentioned in the sources. They're signing deals to potentially power global data centers with clean, steady nuclear energy. It just underlines how absolutely fundamental energy is to this entire digital economy we've been discussing.
It all connects back, which I guess brings us back to that F. Scott Fitzgerald quote mentioned in material.
Ah, yes, the one about first-rate intelligence.
The test of a first-rate intelligence is the ability to hold two opposed ideas in the mind at the same time and still retain the ability to function. That feels like it applies to so much of what we've covered today.
It really does. Crypto's paradoxes, the geopolitical complexities, balancing AI hype with real-world needs. Holding those tensions is key.
It's also worth remembering that story about Jeff Bezos' mother, right? Her brave early investment in Amazon. Just an example, highlighted in your sources, of backing smart, hungry conviction, even when it seemed crazy.
A great example of belief paying off.
And the material also touched on some specific economic and social trend observations, didn't it? Just to be clear, these are observations reported in the source material provided to us.
Right, important distinction.
Things like UK labor market stats, showing job vacancies apparently at a 10-year low, rising unemployment, especially among younger groups, and also London crime statistics, noting increases in gun crime, rape, shoplifting, and mugging theft over a single-year period mentioned in the source.
Yes, those points were included in the material as context, painting a picture of some challenging trends observed by the source authors.
Okay, wow. We've really covered a lot of ground today. From the surprising scale of digital money, these dramatic shifts in global power dynamics, to some really unexpected corners of the market, it's definitely clear we're living through an era of profound interconnected change.
Indeed. I think what really stands out to me from this collection of sources is how often the real opportunities, or maybe the most significant insights, lie just beneath the surface. Seeing past the immediate headlines, questioning the prevailing assumptions.
And being willing to consider viewpoints that might seem contradictory at first.
Exactly that. That willingness to hold those opposing ideas, like Fitzgerald said, that seems to be where the deeper understanding truly starts to emerge.
So as you, our listener, absorb all of this, perhaps consider this final thought. In a world where information is so abundant, often synthetic, and where traditional structures feel like they're under immense pressure, what truly holds its value for you? And maybe more importantly, where will you choose to place your trust going forward?
Disclaimer. North Breach Limited, Nutstuff trading name, is an appointed representative of Messels Limited, which is authorized and regulated by the Financial Conduct Authority. Nutstuff has made every reasonable effort to ensure the information provided in this communication is correct. But Nutstuff makes no representation nor any warranty as to whether the information is accurate, complete, or up to date. To the extent permitted by law, Nutstuff accepts no responsibility for any errors or misstatements, negligent or otherwise. Nutstuff, its associates, officers, or employees may also have interests in the financial instruments referred to in this information by acting in various roles. The information in this media is confidential. If you are not the intended recipient, you are not authorized to use the information in this media in any way. Nutstuff does not guarantee the integrity of any media or attached files. The view or opinions expressed are the author's own and may not reflect the view or opinions of Nutstuff. Electronic communications carried within the Nutstuff system may be monitored.